Market started to move quickly in bond markets at the end of last week and carried on to the early part of this week. We've seen a lot of very sensationalist headlines in and around that, but I think we see it as a very healthy correction in a market that's had tremendous performance this year. I think what's important to acknowledge is that the QE that is in existence is absolutely not going away anytime soon. And the reasons that we needed all that QE in the first place are because we've had the weakest recovery we've ever seen since the GFC. And underneath the surface, asset markets have really needed all of this QE to be able to find the lofty levels that they've all achieved over the last few years. I think that, clearly the bond bears get very excited every time the market sells off. We've had about a 1% sell-off or a little bit more in Australian government bonds so far this month. That's after we've had 4 months this year already of more than 1% returns. So, the market's still up around about high 5% year to date after, good annualized returns over the last few years. So, 3-year numbers being, 6.6% annualized and 5-year numbers being 5.9% annualized. So as much as it is very exciting to see the market moving, it is a financial market. Clearly it rallies and does sell off. We'll get periods of profit taking. I think it's just important to slow down a little bit and think, are we really going into a period where central banks will materially hike interest rates? Absolutely not. Not a chance, no chance that happens. We might get one rate hike from the Federal Reserve, but we're not going back to materially higher rates anytime soon. So there will be a new pricing environment where we've got to find where, there'll be good value in bonds. Bonds are as cheap as they've been since Brexit. And yet, the RBA have actually cut interest rates 25 basis points. So we're excited by the new valuations that are on offer. And, clearly there's some things that we're looking to explore. Look, I think that personally this is a continuation of an existing trend, albeit central banks are now realising that their very deep negative interest rate policies have hurt bank profitability. And when bank profitability suffers, banks are not as willing to lend credit into the economy. And the whole purpose of QE is to get that credit growth and that transfer into the economy, and that hasn't been as robust as central banks would like. So the Japanese in particular have been looking at ways to potentially re-engineer the mechanics of their bond curves, trying to potentially steepen or let long bond yields rise a little bit in order to help bank profitability. Long-dated Japanese government bonds at one point this year had 35% year-to-date returns. And that's just quite mind-melting in what is an environment that we think of negative yielding bonds. How can they be putting up such great numbers? Clearly there's some recalibration and some profit taking there after a move of that magnitude. It absolutely matters to equity investors. So many asset markets have found solace in the fact that yields will be low for a long time and you must get invested because there aren't other alternatives that are seemingly as attractive. I guess when you delve into the product knowledge a little bit and see the actual returns that have been generated in some of these products, arguably, we would always push for an argument for balanced portfolios rather than a particularly heavy skew to any one product, be that equities, bonds, infrastructure, property. But it matters because, clearly if we lift risk-free interest rates of return in economies, that calibrates everything thereafter. And people need to remember that interest rates are the virus that affect all asset classes, be that funding rates in property, be that discount rates in equities. And if they materially rise, clearly that's going to have a very large impact on what is a very heavily indebted consumer, particularly in Australia. We know that household debt is at record levels. So the whole thing is gelled together under the assumption that rates will be here or lower looking forward. And should that be challenged materially, then I think it changes everything. And it, clearly, it'll challenge bond markets to some degree, but it'll certainly have a huge knock-on effect to other asset classes. Now, the interesting thing about bonds, of course, is that when they're performing, you are in receipt of an income with a government bond from the government and a capital gain. When they're selling off, you're still in receipt of income, but there is some capital decay. Now, you don't have to realise that capital decay. If you own the bond to maturity, then there is no loss. It's simply the yield that you purchased the security at. But it does mean that bonds have the ability to rally a lot faster than they can sell off. And I think the bears need to remember that. I mean, as we reset valuations and they do become attractive, there is a huge investor base globally that find that very insatiably attractive, and I think we will start to see a stabilisation of interest rate markets after this period of a bit of a wobble, because clearly valuations have improved tremendously, and that doesn't go unnoticed.